Everyone talks about crypto whales like they are some kind of mythical creatures, powerful, untouchable, impossible to predict. But in reality, they are not myths. They are real people, institutions, and sometimes algorithms who hold so much crypto that they can move markets with a single transaction. And whether you are trading Bitcoin, Solana, or some obscure altcoins on a sketchy DEX, if you are not paying attention to what whales are doing, you are probably already losing to them without even knowing it. Let's break it all down. What are whales? Where did they came from, and how exactly do they influence the crypto markets you and I are trying to navigate every single day? The answer is more interesting and more brutal than most people realize. Let's start with the basics. A whale is simply an entity that holds a disproportionately large amount of particular cryptocurrency. The definition varies depending on the asset, but in general for Bitcoin, anyone holding over 1,000 BTC is considered a whale. That's tens of millions of dollars in value. For smaller coins, the bar is lower. Holding even 100K worth of a microcap token could give you the ability to single-handedly push the price up or down, especially on low liquidity platforms like PancakeSwap or Radium. But holding a lot of tokens isn't enough. What defines a whale is not just their holdings, but the effect they can have on the market. Whales can move prices, trigger liquidations, collapse ecosystems, or send projects flying to new all-time highs. They are the silent hands behind the curtain, the ones whose wallets get tracked by analysis, whose transactions create entire narratives, and whose strategies shape the entire emotional arc of a bull or bear market. Where do these whales came from? There are a few main categories. First, you have the early adopters, people who bought Bitcoin in 2010, Ethereum in 2014, Solana in 2020. There are the OGs. Many of them are pseudo-anonymous, still active and terrifyingly competent. Then you've got the VCs and funds. They are firms like A16Z, Polychain, Jump Crypto, and Paradigm. They get tokens at early rounds, often at 90% discounts, and typically receive large unlocks that they slowly distribute into the market. These are strategic whales. Next, you have projects insiders and developers, founders, team members, and early advisors often receive large token allocation as part of the tokenomics. When these unlock, they become whales by default. There are also centralized exchanges like Binance and Coinbase. These entities hold massive reserves on behalf of users, but can move markets by relocating, lending, or using treasury funds. And finally, you have high-performance traders, people who started with relatively small capital and turned into whale-sized holdings by farming airdrops, leveraging during bull market, exploiting arbitrage, or just being smart as hell. All of these whales share a common trait. They don't just participate in markets, they shape them. And their influence is everywhere. You can see it when a random token pumps 40% after a large wallet starts accumulating. You can see it when a project dumps instantly after a vesting cliff. You can see it when sentiment flips on Twitter following a major transfer to Binance. Whales don't just respond to the market, they are the market. So, how do whales actually move things? Well, they don't just market buy or market sell. That's the amateurs. Whales move strategically. They use limit orders across multiple exchanges to avoid slippage. They spread their holdings across thousands of hundreds of wallets to obscure their true size. They accumulate quietly during periods of low volume and distribute when everyone else is euphoric. Often, they will move tokens and centralized exchanges to create a panic. Retail sees the inflow and assumes a dump is coming, and sometimes the whale does dump, sometimes they don't. They treat alone is enough to shake the market. One common tactic is the stop-loss hunt. Let's say there is a strong support at $1 for a token. The whale knows that tons of leveraged longs have their stops at 0.98. So the whale self-aggressively pushes the price below 0.98, triggers the stops, liquidates retail, and then buys back lower. It is psychological warfare executed with math. Another classic move for whales is baiting a breakout. A whale will buy just enough to push a token above resistance, triggering breakout traders and bots. Then, as the new wave of buyers rushes in, the whale sells into the rally and walks away with profit while retail holds the bag. This isn't theory. It happens daily. During the COVID crash in March 2020, Bitcoin dropped from $8,000 to $3,800 in a matter of hours. Some of that was panic. Some of that was whales offloading massive amounts of Bitcoin into thin liquidity. Then, as retail capitulated, whales bought the bottom. In 2021, a single wallet holding billions of Shiba Inu sent tokens to an exchange. Retail panicked and the price dropped 40% in a day. Even thought the token weren't even sold yet. The mere possibility of a whale action was enough to crush the market. You want more? Let's talk about Luna. In 2022, before the Terra ecosystem collapsed, whales and big funds widely exited their UST and Luna positions, while retail kept farming 20% APY on Anchor. When the back broke, whales were already out. Retail got wrecked. This pattern repeats over and over again. Whales anticipate, retail reacts, and that's the core difference. How can you spot whale activity? You don't need a Bloomberg terminal for that. Blockchain is a public thing. Everything is traceable, and if you know what to look for, you can see what the whales are doing, and sometimes even before the rest of the market realize what's actually happening. Tools like Etherscan, BSC Scan, and SolScan let you track wallets' activity. Whale Alert on Twitter publishes major on-chain transfers. Platforms like Nansen and Arkham Intelligence go further, labeling smart money wallets and letting you see their positions, behaviors, and strategies. You can set alerts when wallets move. You can follow clusters of wallets associated with previous pump and dump schemes or long-term accumulation. You can look at token unlock schedules to see when whales might be ready to sell. You can even watch centralized exchange inflows to anticipate sell pressure. Whale watching isn't paranoia, it's actually survival. Let's talk about ecosystems. Whales don't behave the same way across chains. On Ethereum, whales are mostly OGs and funds. They play slow, smart, with the size. They use LiDAR, Core, Aave. They participate in governance. They act more like institutions. On Solana, whales are faster, more aggressive. The ecosystem is younger and more dig-in. Whales here ape into meme coins, move with boost, and manipulate with terrifying speed. On Ton, it's a mix. Whales include early investors, exchange partners, and Telegram-connected players who are just beginning to flex their influence. The float is small and price move fast. In BNB chain, whales are often tied to centralized power structures. Many are insiders, many market makers. On Arbitrum and Optimism, the whales are farming airdrops and rotating aggressively. It's important to understand not just who the whales are, but where they are and how their environment shapes their behavior. Now, let's get uncomfortable. Most retail investors lose money in crypto. Why? Because they are trading against whales without realizing it. Every time you FOMO into a green candle, a whale is selling into you. Every time you panic sell a dip, a whale is buying. Every time you hold during an obvious distribution phase, a whale is already rotating into the next play. They use your emotion as a liquidity. They need you to react so they can extract. That's the game. But it's not hopeless, and you don't need to be a whale to play smart. You just need to stop being bait. First, stop chasing pumps. If a token is already up 200%, you are probably late. Well, second, track wallets, not influencers. Third, understand vesting and unlock shuttles. Don't buy before a massive unlock. Fourth, avoid low liquidity tokens unless you really know what you're doing. And fifth, please have a plan. Set the targets, stick to them. Don't get greedy, don't get emotional, don't fight the tide, surf it. You want to turn whale activity into alpha? Here's the move. Follow smart money wallets using Nansen or DBank. Watch what they are buying, not what they are tweeting. Join on-chain communities, track token contracts, use tools like Token Terminal to understand real usage. Be early, not loud. Be boring, not brave. And above all, be disciplined. You are not going to beat whales at their own game, but you can shadow them, study them, and move in the same direction before herd show-ups. Let's be real, some whales are good actors. They provide liquidity, they build products, they vote on governance. But others, they are predators. They engineer pumps, they exploit hypes, they dump into you. And they walk away while retail holds the back. It's not illegal, it's just brutal. The next evolution of whales is follows. It's already happening, and in 2025, whales won't just be humans. They will be AI-driven bots. Telegram bots are now executing complex trades. MEF bots extract value from block space faster than any human can. DAOs are coordinating whale-level movements. Staking protocol like IG and Layer are creating new forms of influence. Real-world assets tokenization is onboarding TradeFi giants into crypto. You think it's hard now? Wait until you're trading against Goldman Sachs algorithms dressed up like a DeFi wallets. So, what's your play? You can't outsize them, but you can outlearn them. You can be nimble, you can be early, and you can stay liquid. You can think long-term, you can choose discipline over dopamine, and slowly, cycle by cycle, you can build. Crypto isn't just about tech. It's about psychology, liquidity, and the action power. Whales have all three, but what about you? You've got curiosity, do you? You've got time, do you? You've got this studio. So please take what you've learned and use it. Track wallets, study behavior, follow flows. Know who you are trading against and never forget, this is a game. It's not fair, but it is winnable. If this helped you understand the game better, like the video, subscribe to Botanica Crypto Media, and share it with someone who needs to stop swimming like plankton. See you in the next one.